Hey friends, Jacqueline here with Zenith Home Loans. Thank you so much for joining me for today's TCA Tuesday, Total Cost Analysis Tuesday. What I wanted to look at is, okay, so we've gotten you into all of this debt with your new mortgage loan. So how do we get you out of it? Because the loan doesn't stop just because we've closed on the house or taken care of the refinance. Now we want to look at, okay, so now that we have the home or we've refinanced into a structure that just makes more sense financially for us based on whatever our needs are at the time that we do the refinance, what else can we do to get into an even better financial situation into the future? So what I'm going to do is I set up a scenario for you to take a peek at. This is one of my clients that just closed on their home back in January. And what we did is it's called the skip the bagel or skip the coffee, basically just looking at what does it take or what happens when we make a little bit extra payment towards the principal. So I'm going to share my screen with you here in just a second, but I do want to preface this with one thing. So mortgage debt is considered good debt. So the reason for that is because it's for, it's the equity in the home that you're gaining. It's the mortgage interest that you have access to write off into the future. So that's going to save you on your income taxes. So I don't generally tell clients, depending on what stage in their life they are in, to try to make extra payments to the principal right off the bat. What it generally makes more sense to do is take, if you were going to say, hey, I want to make an extra $100 per month to my monthly payment. Instead of doing that, take that $100 and go pay off a credit card debt. If you've got some high interest credit cards or some other kind of debt that you have that you need to take care of. If all of that's taken care of, then take those funds and again, instead of applying them to your mortgage balance, because keep in mind, you're still gaining equity in the property every time you make a payment. And as the property appreciates, you don't need to pay that loan off yet. And there's really not a financial advantage to do that, especially if it's your very first home, at least not right off the bat. People are going to disagree with me on that, and that's okay. But maybe, okay, are you contributing enough to your 401k? Do you have a retirement plan set up? Is there any other financial investments that you could be making that will help create this compound effect of your financial future? So take a look at those factors first. That being said, I have this scenario set up for you. So I'm going to go ahead and share my screen. And we can take a look at what this does. So these particular clients, their purchase price was $305,000. And we did an FHA loan. So they do have mortgage insurance. So at some point, I do want to refinance them out of this loan, get them out of that mortgage insurance. So that will be a goal. But what we did here is we just took a couple of options and figured out, okay, if we make an extra $100, $200, or $300 to the payment, what does that do over time? So their total monthly payment is $1949. This is an all-in payment. So we're going to add those 100, 200, and 300. So if you scroll down here, it's going to show you what my freedom point is. So they're currently in 29.92 years because they've got one house payment and it's due this next upcoming month. So we haven't even made a house payment yet. But if they made just an extra $100 per month on the payment, that's going to shave off, what is this? Almost 4 years. So 3.5 years off the total life of the loan. Okay. If we had $200 per month, we're going to shave off an additional couple of years. So now we only have this loan for another 23.83 years. If we shave off $300 off the loan, that's going to get us down to just shy of 9 years. So you can see how this compounded over time is going to create this big impact. And so if we look over here on the right-hand side, it says interest in mortgage insurance. That's what MI is, paid in the next 15 years. So currently, they're scheduled to pay $129,494 over the next 15 years. If we add that extra $100, we're going to save them $5,000 in the next 15 years. Or now we only pay 119, or now we only pay 114. So over time, you're going to shave interest off of the loan because we're paying down that principal balance faster. And why this matters is it's going to create a better equity position for you into the future. If you're in a position where you're like, nope, this is my forever home and I want to start making big payments on the loan right away, this is just basically showing you how you're going to do this faster. This is also what we're going to look at when it's time, or if it's time to do a refinance. We're going to say, okay, your current payment is this $1950 per month, and we're going to save you $100 per month. And how long is it going to take us to recoup any of your closing costs? And when will you, what's it going to be? What's our cost benefit? So how much am I really saving you? So when it comes to a refinance for these particular clients, our big goal is going to be, we want to get rid of this mortgage insurance, which is about $60 per month. It's not that much in the grand scheme of things, but at some point we want to just help them get rid of it. So doing the refinance is how we're going to be able to do that, because these particular clients are in an FHA loan. So we want to get rid of that mortgage insurance through a refinance, because as of right now, as the rules currently stand, you can only get rid of mortgage insurance on an FHA loan through a refinance or a sale of the property. And so a lot of times it might make sense for us to look at shorter loan terms, or maybe we look at a 30-year fixed versus a 20-year fixed. And so we can pay that freedom point off. We don't want to, or we can set up that freedom point to take place earlier in the timeline of when we're going to get this property taken care of. And so what we want to look at is, I don't want to just keep restarting that 30-year term every 2 years, because at some point we're wasting money. So we want to constantly be paying attention to that. But this is a really good way and a very tangible way to just kind of see what making that extra payment over time will do. And it's not something that you have to do every single month. It's, if you have a little bit extra this month, okay, cool, let's make a little bit extra towards the payment. I get asked a lot about comparing 15-year loans to a 30-year loan. The thing to keep in mind too is, we've got a 30-year, but we also have a 25, a 20-year, the 15 and the 10. And you can always make the payment as though it were the 15-year payment or as though it were the 20-year payment, and it's going to accomplish the same goal. What's nice about not putting yourself into that 15-year, if it doesn't completely make sense financially, is now you're not obligated to that higher monthly payment. So maybe there's a month where it just feasibly doesn't make sense for us to make that larger payment. Now we have the ability to decide for ourselves, okay, this month I have this extra unexpected expense because my dog ate a tennis ball and it's going to cost me $5,000 and I just don't have any extra to spare. So instead of having this really high monthly payment because we decided to do a 15-year, I'm just going to go back to my 30-year instead. And so now I don't have to worry about not being able to make my payment. So it's really important, even though a lot of times we're going to see lower rates on these shorter loan terms, is taking a look at the overall picture of what our loan could look like and what those payments might look like, and just anticipating potential items that might come up down the road, because it's not just about the payment today, it's about the payment into the future. So my goal and part of our conversations that we'll have with you when we're looking at that pre-approval process is, what's the monthly payment that you think you're comfortable with? And then what do we qualify for? And we find out where that threshold is, because my job is going to be just to do that gut check with you to make sure we're still in a monthly payment that makes sense, and then give you the option to make extra payments towards the principal whenever you want to, just to pay that balance down faster. So I hope this was helpful information. Like I said, I just wanted to kind of show you what happens when you make those extra payments towards the principal of the loan, and over time what that compounded interest does for your overall loan, how much is going to end up saving you over the lifetime of the transaction. Smaller loans are going to have a little bit less of an impact, or they're going to have a much bigger impact than your larger loans, just because $100 towards a loan that's only $100,000 is going to make a much bigger impact versus a $500,000, $600,000, $700,000 loan. But making those extra payments when you can always makes sense, as long as you've taken care of the other stuff. So paid off high interest debt or any other debt that you might have, and you're contributing to a 401k or some other type of retirement account for you so that you're protected into the future. And then let's start knocking out the mortgage. I hope that's helpful. If you want to talk more about strategy or game plans or pre-approvals, or maybe it's time to do a refinance, maybe we want to use the equity in our home to consolidate all of that high interest loan so that we can just start throwing extra money to the payment, that's a great way of doing it too. So whatever your goals are, I bet I can help you get there.